If you died tonight, your family could walk into your bank tomorrow with your death certificate, your will, and every legal document you ever signed, and still leave with nothing, not because the money is gone, not because they are not your heirs, but because the bank does not care what your will says in that moment, and that is exactly how families get blindsided. There is one simple form that can stop this from happening. It is free. It takes about 10 minutes, and most people never fill it out because almost nobody ever tells them it exists. My name is Lana Maines. I represent taxpayers directly in front of the IRS, and I deal with bank compliance officers and federal agencies on behalf of real families. If this kind of information matters to you, subscribe, because every week I break down the legal and financial rules that can protect your money and your family without the confusing jargon. The most heartbreaking financial disaster I see is not a failed investment. It is not a tax problem. It is a family, already in shock, standing at a bank counter days after a death and hearing the words, "We can't release the funds." Money that was supposed to pay for the funeral. Money that was supposed to keep the bills current. Money that legally belonged to the family. Frozen. All because one form was never filed. And the worst part? That form costs nothing. You do not need a lawyer to complete it. It takes minutes. But unless someone who understands the system points it out to you, there is a good chance no one ever will. Why your will means almost nothing at the bank counter. Most people grow up believing one thing. If you have a will, your affairs are in order. That sounds reasonable. But when it comes to your bank account, that is often not true. Your checking account, your savings account, your credit union balance, those accounts are governed first by the contract between you and the bank, not by the document in your nightstand, not by the notarized will in your safe, not even by the estate plan your attorney prepared for you. That is the part almost no one explains. When you die, the bank does not start by asking, "What did the will say?" The bank starts by asking, "What instructions are on this account?" If there is a valid beneficiary designation on file, that controls. If there is not, the account usually becomes part of your estate. And the second that happens, probate enters the picture. Probate is the court-supervised process of validating a will, resolving claims, and distributing assets. And once your money gets pulled into probate, your family is no longer operating on their timeline. They are operating on the court's timeline. That means delays. That means fees. That means waiting while life keeps moving. In many states, the law builds in a creditor waiting period that can stretch for months. During that time, possible creditors must be given a chance to come forward before money can be distributed. It does not matter if your finances were clean. It does not matter if your wishes were obvious. Your family still waits. But the funeral home does not wait. The mortgage does not wait. Credit card bills do not wait. Grief certainly does not wait. Dorothy's story, everything was handled until it wasn't. Let me show you what this looks like in real life. Dorothy was 71 years old, a retired school teacher in Illinois. She sold the family home and deposited $350,000 into a standard savings account at her local bank. She did what responsible people are told to do. She hired an estate attorney, paid $800, and had a full will prepared. It was signed, it was witnessed, it was notarized. It clearly named her 2 adult children, Michael and Sarah, as equal beneficiaries. Dorothy put the will away, called her son, and told him everything had been taken care of, but it had not. What Dorothy never did was file a payable-on-death beneficiary form with the bank. Then she suffered a stroke and passed away. Michael and Sarah flew in, planned the funeral, and got hit with an $11,500 bill. Like most children in that situation, they assumed the money their mother left behind would be available to cover it. Michael took the death certificate and the notarized will to the bank. The manager looked at the screen, looked at the paperwork, and slid it all back. No beneficiary was listed on the account. The account was in Dorothy's name only. And because the balance was above the state threshold, the bank could not legally release a single dollar. That is the moment families never forget. You are standing there with proof, with the will, with the death certificate, with funeral costs already piling up. And still, the answer is no. Because a will is not what the bank follows at the counter. A will gives instructions to the probate court. The bank follows the account contract. And Dorothy's account contract named no one, so the money was frozen. Michael and Sarah left the bank with zero access to their mother's savings. They had to put the funeral expenses on their own credit cards, at interest rates above 20%, while $350,000 of their mother's money sat just a few feet away, locked behind a system they had no power to bypass. Then probate started. There was a court filing fee. There was a publication requirement to notify possible creditors. There was an executor bond premium. There were legal fees tied to the size of the estate, and because the mandatory waiting period had to run, the case dragged on. From beginning to end, Dorothy's family waited 14 months to reach money she believed she had already left to them. They lost more than $12,000 in direct, documented costs, not counting the interest that kept building on the credit cards used to cover the funeral. Dorothy did not ignore the law. She did not fail to plan. She had a lawyer. She had a will. She had everything people are told they need. What she did not have was the one form that actually controlled the account, and that made all the difference. Stop for a second and check this right now. Before I explain the 3 biggest traps, do this first. Open your banking app or pull up your latest bank statement. Look for any mention of a beneficiary. If you cannot find one, or the space is blank, that alone should get your attention. Because most people fall into one of 3 problems, and every one of them can quietly set their family up for a nightmare. Failure. Point number 1, no beneficiary at all. This is the most common one. You opened the account years ago. Maybe nobody asked you about a beneficiary. Maybe they did, but it was buried in paperwork and never explained. You signed where they told you to sign, opened the account, and moved on with life. And like most people, you assumed your will would take care of the rest. It will not. If no beneficiary is attached to that account, the money usually goes into your estate, and that means probate. For families with limited savings, that can be brutal. A 6-month or longer delay on a modest account can drain meaningful money through court costs, publication expenses, and attorney fees before your loved ones ever see a dime. For middle-class retirees, the mistake is usually different. They think, I already hired an estate attorney, I already handled that, but drafting a will is not the same as filing a beneficiary designation with a bank. Those are separate actions at separate institutions, and almost nobody explains that clearly when the check for the estate plan gets written. Failure point number 2, the wrong person is still listed. This one is even more dangerous because it makes people feel safe when they are not. Maybe you did fill out a beneficiary form years ago, but it named an ex-spouse, or a parent who has since passed away, or a sibling you no longer want receiving the money. That old name is still sitting on the account. And if you die with that designation unchanged, that is the person the bank will look at first. A lot of people think their current will cancels out the outdated bank form. It does not. The bank follows what is on file with the bank, not the will in your drawer, not the updated estate documents in your closet, not the instructions your family swears you wanted, the form on the account controls. That is why outdated beneficiary designations are such a dangerous trap. They give people a false sense of security right up until the moment it is too late to fix them. Failure point number 3, adding a child to the account. This one comes from good intentions. A lot of parents, especially seniors, add an adult child as a joint owner on the account because they want someone they trust to be able to help if something goes wrong. It feels simple, it feels practical, it feels like a shortcut, but legally it can create a huge problem. The moment you make someone a true joint owner, in many states the law can treat part of that money as theirs while you are still alive. That means their risks can become your risks. If your child is sued, your account may be exposed. If your child gets divorced, your savings may suddenly become part of a legal fight. If your child owes taxes, the IRS may come after funds connected to that account. So, in trying to avoid a probate problem later, people sometimes create a liability problem right now. A payable-on-death designation solves that much more cleanly. It gives your beneficiary no ownership rights while you are alive. They do not control the money. Their creditors do not gain access to it just because they are named. The account stays fully yours until your death. Then it transfers directly according to the bank contract without dragging your family through court first. The form that makes the difference. That form is called a Payable-on-Death designation, or POD, And this is the part that matters most. It works on the same legal track the bank already recognizes. It is not trying to override the bank from the outside. It is built directly into the account relationship itself. So, when a valid POD is on file, your beneficiary can usually bring in a certified death certificate. The bank verifies the record, and the transfer moves forward without probate controlling that account. No judge, no long court delay, no drawn-out waiting period before the bank can act. Depending on the institution, the process may take a few days. Some smaller banks move even faster. But what it does not take is months of legal limbo while your family scrambles to cover immediate costs. And the form itself? Free. No filing fee. No annual maintenance fee. No attorney required just to complete it. It is one of the simplest protections available, and yet it is one of the least talked about. What it covers and what people miss. Now here is where people make another mistake. They assume one fix covers everything. It does not. A POD designation usually applies to regular deposit accounts like checking, savings, and money market accounts, but other assets may need their own separate beneficiary instructions. A certificate of deposit may require its own designation. A brokerage account usually needs a transfer on death, or TOD, form instead. Retirement accounts like IRAs and 401ks already use beneficiary designations, but those designations need to be reviewed and updated regularly. And that matters more than people realize. If your IRA still names a former spouse from decades ago, that outdated form can create a serious legal mess. If your brokerage account has no TOD on file, those assets may still end up in probate. If your safe deposit box holds your key documents, your family may face delays accessing the very papers they need. This is why you cannot assume one will cover all of it. Every account has to be checked on its own. What you need to do next. Do not wait on this. This week, contact your bank and ask for the Payable-on-Death beneficiary form for every eligible account you have. List a primary beneficiary using complete, accurate identifying information. If the bank allows it, add a backup beneficiary too. Then make sure you receive confirmation that the designation was actually recorded. After that, repeat the process across every relevant account. Check your checking, check your savings, check each CD separately. Call your brokerage and ask about TOD forms. Review every retirement account beneficiary you have, and revisit all of it after major life changes like marriage, divorce, death, or family changes. Because the truth is simple. Tonight, your family may still have no legal way to touch the money in your account if something happens to you. Not because you did not love them, not because you did not work hard for that money, not because you failed to make a will, but because the bank will follow the contract on file. And if that contract says nothing, the court steps in. So go to your bank. Ask for the POD form. Take the 10 minutes. Do the one thing that can spare your family months of stress, delay, and unnecessary expense. And if this helped you, subscribe.